On Wednesday afternoon, 40% of the S&P 500's entire tech weight is going to just slam headfirst into the Federal Reserve's monetary policy.
Right, and trillions in AI infrastructure spending are demanding immediate ROI, all while the cost of capital is surging.
It is a powder keg.
Oh, the fuse is already lit. I mean, if you look at the algorithmic order flow from last week's close, institutional managers aren't waiting for Wednesday.
They're already de-risking.
Exactly. They're actively restructuring their books. We are transitioning violently from this narrative of, infinite total addressable market to a really brutal regime of margin verification.
The leniency period is over.
It's completely over.
Which makes this exact window critical. It is Sunday morning, July 26, 2026. The market is closed, the ticker tape is frozen. You have exactly 24 hours before the opening bell tomorrow morning to map these structural fault lines.
And walking into tomorrow morning without understanding the mechanical traps waiting in the derivatives market is, well, it's financial suicide.
Yeah. We are tearing through the institutional weekend prep scripts, the COT futures positioning, and the macro event risk matrix. Our objective for this deep dive is to give you a tactical roadmap.
Because you're stepping into what strategy desks are just uniformly calling the single highest volatility stretch of the summer macro calendar.
We're translating the cross-currents into a definitive game plan. We have conflicting data sets, severe technical damage, and a synchronized macro gauntlet that will force a repricing of risks.
Across every single asset class.
Right. So the primary collision we are tracking is what the institutional notes have dubbed AI ROI versus Fed policy reckoning. But before we project forward into that, we have to forensically examine the footprint left behind on Friday.
Resetting the deck, essentially.
Exactly. Resetting the deck. The weekly print was just ugly. The S&P 500 gave up 0.6% to close at 7,411.98.
Yeah, and the Dow slipped 0.4% to 51,947.25.
But the absolute center of gravity for the liquidation was the NASDAQ composite. It plummeted 2.1% to 24,975.82.
But the raw percentages actually mask the severity of the internal damage. I mean, when you pull up the weekly time frame, specifically on the NASDAQ, you are looking at a textbook weak rejection.
Explain that for the active trader.
So the bulls attempted to drive prices up into the upper resistance bands early in the week, right? They were hunting for fresh all-time highs.
Hoping to trigger those breakout momentum algos.
Right. But instead of triggering those algos, they just ran into a massive wall of institutional supply. The sellers absorbed all that liquidity and aggressively faded the rally.
Pushing the closing price all the way down near the weekly lows.
Exactly. It's the visual footprint of a failed breakout.
But zooming out and looking at the technical damage reports, the internal structure of the market is severely fractured. It's really a tale of two trend lines.
Yeah, the S&P 500 actually managed to hold its primary weekly uptrend. I mean, it bent, but it didn't break.
While the NASDAQ 100 fractured completely, it sliced right through its immediate multi-week support trend line to close at 28,128.34. So the S&P survived, but the NASDAQ is basically in free fall.
But the S&P 500 survived purely because of sector rotation.
Yeah.
You have to remember, the index is fundamentally a multi-sector weighted average.
Right.
So capital aggressively exited the mega cap tech concentration at the top, but it didn't rotate into cash.
It rotated laterally.
Exactly, into financials and healthcare.
Yeah.
The bid underneath XLF and XLV provided just enough buoyancy to keep the broader S&P trend line intact.
So it's essentially a Jenga tower. Like the S&P 500 is still standing because portfolio managers carefully pulled the load-bearing blocks from the top, the tech heavyweights, and slid them down to reinforce the base.
With healthcare and financials, yeah.
The structure is wobbly, but it holds. But the NASDAQ is a tower that just had its entire middle section violently yanked out.
The structural integrity is just gone.
But wait, looking at the tape from Thursday and Friday, I see a glaring anomaly that kind of challenges this whole panic narrative.
So the volume.
Yeah, the equity trading volume during this pullback was actually below average. I mean, if this is a structural fracture, where is the volume?
That's a fair point.
If institutions are truly distributing, shouldn't we see massive block trades? This looks more like, late July seasonal illiquidity. The senior desks are out, the algos are just pinging each other. Doesn't low volume invalidate the breakdown?
It's really tempting to brush this off as summer illiquidity, but if you look at the options market, the volatility premiums weren't on vacation.
Market makers were pricing in real tail risks.
Massive structural tail risks.
Yeah.
You are correct that we didn't see an aggressive, broad-based sell everything liquidation, but the heavy volume that did execute, it was hyper-concentrated.
In single stock earnings reactions,
Exactly. Look at the tape on Tesla and Intel.
the volume there was astronomical.
Right. And that indicates tactical, surgical de-risking. Asset managers aren't dumping the index blindly. They're actively unwinding exposure to specific balance sheets where the forward guidance is cracking.
So they're heavily reallocating ahead of the event risk.
It's a sniper rifle approach to distribution, not a shotgun.
Which feeds directly into the dominant theme driving that selective liquidation. The institutional briefings are just obsessed with this concept of AI CapEx anxiety.
It's the only thing that matters right now.
Over the last 24 months, the market rewarded literally any CEO who uttered the phrase generative AI. It was a total land grab.
Yeah, companies were aggressively capitalizing massive purchases of GPUs, data center cooling systems, you name it.
And the market essentially granted them a valuation premium just for proving they were, participating in the arms race.
Well, that leniency is mathematically over. The early Q2 tech earnings from the hyperscalers, Alphabet specifically, and Tesla's forward projections, they triggered a severe reality check.
Wall Street's patience is exhausted.
Completely. The patience for open-ended, multi-billion-dollar infrastructure spending without a clear line of sight to monetization is just gone.
The rhetoric has shifted entirely. The institutional notes explicitly state that investors are demanding immediate proof of top-line revenue growth and margin expansion directly attributable to AI.
They are looking at the depreciation schedules of these tens of thousands of H100 and B100 GPUs.
And those are about to hit the income statements hard.
Right. And they are demanding the return on investment right now. The days of trading at 40 times forward earnings on a promise of, a software rollout in 2028 are dead.
Because the cost of waiting for that 2028 revenue has absolutely skyrocketed. And this is where the AI ROI narrative collides violently with the Fed policy reckoning.
A macro cross-current.
Exactly. While tech is being put on trial for its spending habits, the 10-year Treasury yield is becoming increasingly hostile.
We saw the yield settle Friday at 4.69%.
Pushing aggressively toward multi-month highs near 4.71%. And the macro drivers there are entrenched energy inflation fears and escalating geopolitical friction.
Let's translate the mechanics of that 4.69% yield for the active trader, heavily allocated to tech.
Okay, think of the 10-year yield as gravitational pull. Tech stocks are long-duration assets, right? They are rockets designed to reach their peak profitability 5 or 10 years in the future.
Right. When the risk-free rate sits at 2%, gravity is light.
The rocket can easily achieve escape velocity. But when that yield surges to 4.7%, gravity doubles. To maintain the exact same valuation altitude, that tech company suddenly needs to produce twice as much immediate revenue to justify the risk.
And the discount rate mechanism is ruthless. Financial models discount those massive future AI earnings back to present-day dollars.
Right.
If an allocator can secure a guaranteed, risk-free 4.7% return from the U.S. government, the equity risk premium required to hold a speculative AI asset expands drastically.
A sustained move above that psychological 4.7% cap mathematically forces a multiple compression on growth stocks.
The higher the yield, the less those future AI profits are worth today. It's just math.
The strategy briefings identify 4.55% as the critical pressure release valve. If the 10-year yield doesn't slide back below 4.55%, the entire technology sector is essentially trying to run a marathon while breathing through a straw.
The macro headwind is suffocating the valuation multiples.
Which sets the stage for the macro gauntlet kicking off on Wednesday. Because the market doesn't have to wait months to resolve this tension between AI spending and the cost of capital.
No, we are going to get definitive, violently binary answers on both fronts in a compressed 48-hour window.
Let's map the calendar because the density of event risk here is just staggering. Wednesday, July 29th, we have a direct collision.
At 2:00 p.m. Eastern, the FOMC releases their rate decision.
Followed by the Fed press conference at 2:30.
And simultaneously, within this same 48-hour block, Microsoft, Meta, Apple, and Amazon all report their Q2 results.
So you have the Federal Reserve dictating the future cost of capital at the exact moment that 40% of the S&P 500's tech weight is defending its capital expenditures.
The cross-asset volatility metrics are pricing in a massive move.
Let's break down the binary scenarios on the Fed side first.
Okay, if the FOMC delivers a hawkish hold, meaning they reinforce the higher-for-longer stance and cite sticky services inflation, the immediate reaction function is a spike in Treasury yields across the curve.
And if that 10-year yield breaks definitively above 4.71% on a hawkish Fed, the long-duration growth equities get absolutely crushed.
The discount rate rises, multiple compression accelerates, and honestly, the tech earnings don't even matter at that point.
They're fighting an impossible macro current.
Conversely, if the Fed pivots dovish, if they acknowledge the softening labor market data we've seen recently and provide explicit forward guidance for rate cuts heading into the autumn, the yield curve shifts downward.
Yields slide rapidly back toward that 4.55% level, the pressure valve releases, and you trigger a massive, broad-based risk-on rally.
But the Fed is only half the equation. The mega cap earnings have to justify their weight.
Let's dig into the individual exposure layer. Microsoft and Meta are arguably the two most critical prints of the week.
Absolutely. Microsoft has been the poster child for AI monetization with their Copilot integration and Azure cloud growth.
But the whisper numbers suggest the capital expenditure for integrating OpenAI's models is severely dragging on their free cash flow margins.
Microsoft has to thread a microscopic needle here. They need to show that Azure's growth rate is accelerating fast enough to offset the billions they're sinking into data centers.
If Azure growth misses by even a fraction of a percent, the market will punish the stock. They'll interpret it as a failure of AI ROI.
And Meta is facing a similar existential test.
Right, Mark Zuckerberg has historically shown a willingness to pivot aggressively, but the burn rate at Reality Labs, combined with their massive GPU purchases for AI ad targeting models,
It has to translate to immediate top-line ad revenue.
Apple and Amazon have completely different structural vulnerabilities this week, though.
Yeah, Apple isn't really playing the cloud AI game. They are relying on edge AI, pushing the processing to the device to trigger a massive iPhone upgrade cycle.
So the guidance they give on Wednesday regarding iPhone 16 pre-orders is going to dictate their entire quarter.
While Amazon has Andy Jassy aggressively cutting costs in the retail division, but AWS is bleeding capital to compete with Azure in the AI space.
If AWS shows any margin compression, the entire cost-cutting narrative at Amazon unravels.
The overarching theme for all four of these titans is that the market is no longer pricing them on innovation potential.
They are being priced as utilities that need to deliver cash flow today.
Exactly.
And as if Wednesday wasn't enough, Thursday, July 30th, delivers a dual macro shock. At 8:30 a.m. Eastern, the U.S. Q2 advanced GDP drops alongside the June core PCE price index.
Core PCE being the Fed's preferred inflation gauge, of course.
The strategy notes map out two distinct paths here, the Goldilocks scenario versus the reacceleration nightmare.
The interplay between growth and inflation on Thursday morning will completely rewrite the algorithmic order flow.
Let's look at the reacceleration scenario first.
If core PCE comes in hot, specifically in the supercore services component, and the GDP print shows robust, resilient economic expansion, the soft landing narrative dies instantly.
Because strong GDP combined with sticky inflation gives the Fed absolute cover to keep rates restrictive indefinitely.
Rate cut expectations get entirely priced out of the Fed funds futures market.
Equities will plunge as the market prices in a higher terminal rate.
But the alternative is the Goldilocks print. If core PCE moderates, showing sequential disinflation, but GDP holds steady avoiding recessionary contraction, you have the perfect environment for equities.
Inflation cools, the economy survives, and the Fed has the green light to cut.
And that scenario drives multiple expansions for the S&P 500.
But the real wild card, the release that could just upend everything, hits on Friday, July 31st at 8:30 a.m.
The Q2 Employment Cost Index, the ECI.
Now, for the active trader used to trading the volatility of non-farm payrolls or CPI, the ECI often flies under the radar. But the institutional desks are hyper-fixated on this print. Why?
Because central bankers obsess over the ECI. It is the most comprehensive measure of broad labor costs. It calculates wages, benefits, bonuses, the total aggregate cost of employing a human being.
And the Fed watches it because it is the leading indicator for sticky wage push inflation in the services sector.
Which is the core of the inflation fight right now. Goods inflation, the cost of used cars, televisions, raw commodities, that is largely normalized.
But services inflation, the cost of medical care, legal services, hospitality, that is driven entirely by labor costs.
Right. If companies are forced to pay higher wages to retain talent, they inevitably pass those costs onto the consumer,
creating an entrenched wage price spiral.
There's a terrifying historical precedent here. If you look back at the 1970s under Fed Chair Arthur Burns, the failure to contain wage push inflation led to a structural derating of equities that lasted for a decade.
Despite massive technological innovation during that era, equity multiples compressed because profit margins were constantly eroded by surging labor costs.
If the ECI comes in hot on Friday, it proves that the Arthur Burns scenario is still on the table.
It forces the Fed into a corner and it directly compresses the profit margins of every labor-intensive company in the S&P 500. So we have the map of the event risks. Now we need to forensically track where the smart money is moving right now, because the institutions didn't go home flat on Friday. They laid their traps.
Let's look at the firing line, the sectors, and the positioning data.
The most exposed ETFs heading into Wednesday are Technology, XLK, and Communication Services, XLC. We already established they are hypersensitive to the 10-year yield and the FOMC because of their valuation multiples.
But the defensive sectors are equally vulnerable. Look at real estate, XLRE, and utilities, XLU.
These are structurally treated as bond proxies by the market.
Investors park capital in utilities for the high, stable dividend yield. But that creates extreme convexity risk heading into a Fed meeting.
Because their performance is entirely inversely correlated to the Treasury yield. If the Fed is hawkish on Wednesday and the 10-year spikes to 4.75%, the capital flight from utilities will be violent.
No portfolio manager is going to assume the equity risk of holding a utility stock for a 4% yield when they can lock in a risk-free 4.75% in a government bond.
The capital drain from XLRE and XLU will be instantaneous.
On the other side of the spectrum, you have consumer discretionary, XLY, and industrials, XLI.
These sectors are in the crosshairs of Thursday's GDP and Friday's ECI data.
They are highly cyclical and heavily dependent on top-line economic expansion. But more importantly, they are massive employers.
If the ECI shows surging wage pressures, these are the exact companies whose margins will be compressed the fastest.
The sector exposure provides the target, but the COT report, the commitments of traders data released Friday afternoon, reveals the weapon.
The COT data strips away the noise and shows us exactly how the leveraged funds and asset managers are structurally positioned in the futures market. And the divergence here is shocking.
The COT report separates the participants. We're looking at the asset managers, the pension funds, the long-only structural money versus the leveraged funds, which encompass the fast money hedge funds and commodity trading advisors.
Let's pull the data on the S&P 500 futures. Leveraged funds actively cut their net short exposure into Friday's close. They dumped over 44,000 contracts.
They added 19,000 fresh longs and aggressively covered 25,000 shorts.
The aggregate speculative net position narrowed to negative 16.8K. Meanwhile, the asset managers are holding firm on a massive mountain of structural net longs, nearly 925,000 contracts.
The fast money is unwinding their shorts on the broad index. They are neutralizing ahead of the Fed.
They are terrified of Goldilocks scenario, forcing a massive broad market rally, so they de-risked their S&P shorts.
But when you pivot to the NASDAQ 100 COT data, the posture is completely inverted.
The leveraged funds use the recent technical breakdown to build heavy, fresh, short positions against the NDX.
They are isolating the tech sector. They are betting that the AI CapEx anxiety will fundamentally break the mega caps, and that the Fed will remain hawkish enough to crush the multiples.
It's an incredibly aggressive, concentrated, directional bet against technology.
And we see the capital from that S&P short covering rotating directly into the Russell 2000.
The small cap COT data shows leveraged funds adding new long exposure and flipping net long.
They are front-running a potential rate cut by pivoting into the most interest rate sensitive, under-owned sector of the market.
Synthesizing this positioning, we have to address the structural health of the rally. Zooming out, when you look at the massive run the indices have had over the last 12 months, the immediate instinct is to assume the market is overbought, euphoric, and ready for a cyclical top.
But the quantitative data in the strategy briefings explicitly rejects that thesis.
The internal mechanics do not support a blow-off top scenario.
A euphoric market is characterized by exploding open interest in the futures market, massive retail leverage, and parabolic price action as everyone chases the peak. That isn't what is happening.
Open interest actually contracted on the S&P 500 during this recent consolidation phase between 7,450 and 7,500.
It's a positioning reset. The market has been digesting the gains, weeding out the weak hands, and fragmenting.
Because we haven't seen a euphoric blow-off, there is no immediate technical exhaustion. The runway is clean.
The market actually possesses the kinetic energy to execute a massive, explosive directional move once the macro data drops this week.
And that explosive energy combined with this highly fragmented, concentrated positioning, creates the perfect environment for institutional traps.
In market microstructure, this is defined as the pain trade.
The directional move that inflicts the maximum amount of financial destruction on the maximum amount of leveraged participants.
The market is a heat-seeking missile for over-leveraged consensus, and the weekend scripts outline 3 highly specific pain trades setting up for tomorrow morning's open.
Let's hit them. Pain trade number 1, a violent tech short squeeze.
This is the direct result of the NASDAQ COT data. The leveraged funds are leaning aggressively short on tech, relying on a hawkish Fed and weak AI monetization.
The setup requires extreme precision. The trigger for this pain trade is a dual beat.
If Microsoft or Meta step up on Wednesday and deliver a flawless quarter, proving that Azure and AI ad targeting are generating massive, immediate free cash flow, and the Fed simultaneously offers a dovish concession on rate cuts, the entire short thesis evaporates in milliseconds.
The mechanics of the squeeze are brutal. Fast money shorts are holding borrowed stock. When the price gaps up on the earnings beat, their prime brokers instantly demand more margin collateral to cover the escalating losses.
The commodity trading advisors, the CTAs, have hard-coded risk limits. Once those limits are breached, the algorithms automatically execute market buy orders to close the short positions.
Which forces a wave of indiscriminate buying into an already rallying market. And you have to factor in the options market makers.
Right, if retail and institutions start aggressively buying call options on Microsoft to chase the rally, the market makers who sell those calls have to dynamically hedge their exposure by buying the underlying stock.
It creates a gamma squeeze. You have hedge funds forced to buy to cover, algorithms forced to buy on momentum triggers, and dealers forced to buy to hedge.
It's an upside velocity trap that will liquidate those fresh NASDAQ shorts instantly.
Pain trade number 2 is equally destructive for relative performance managers. Small cap momentum.
The setup here revolves around the structural underweight positioning in the Russell 2000.
For the last 2 years, institutional allocators have treated small caps as radioactive due to their massive floating rate debt exposure. Small caps are essentially walking zombie companies that need cheap debt to survive.
But as we saw in the COT data, leverage funds just flipped long. The trigger here is purely based on benchmark mandates.
Institutional momentum managers running mutual funds are graded exclusively on their relative performance against the S&P 500.
If Thursday's GDP data comes in Goldilocks and the Russell 2000 continues to drastically outperform the broader market, those portfolio managers are trapped.
They have zero exposure to the exact sector driving the alpha.
And underperforming the benchmark for a quarter is a career-ending event in asset management.
They can't afford to be intellectually stubborn. They will be forced to hold their noses and blindly chase the small cap index higher, aggressively buying into the Russell just to close the performance gap.
That forced panic buying from massive institutional funds will accelerate the small cap rally into a parabolic squeeze.
The final pain trade outlined in the prep scripts is the ultimate macro wildcard, an energy volatility rebound.
Over the past week, crude oil WTI surged roughly 7%.
The market has largely ignored this because everyone is hyper-fixated on NVIDIA, Microsoft, and AI capex. But the positioning in energy is incredibly lopsided.
Macro funds and CTAs are sitting on massive legacy short positions in crude oil, betting that global economic growth is slowing and demand will crater.
The trigger for this pain trade is a technical breakout. If WTI crude pushes through its topside resistance levels early this week, the contango structure breaks, and those macro shorts will face immediate, severe margin calls.
The irony is profound. The entire street is modeling out Microsoft's data center costs and parsing every syllable of the Fed chair's press conference. But a sudden, violent spike in crude oil is the stealth bomber that destroys the entire macro narrative.
Because oil is the baseline input for everything. If crude spikes, it instantly feeds into the manufacturing, shipping, and travel components of the inflation data.
It shatters the Fed's inflation models. If oil goes on a tear, the Fed cannot physically pivot to a dovish stance, regardless of what the tech earnings look like.
It is the domino that knocks the entire board over. Which brings us to the operational parameters for tomorrow morning.
You have the macro roadmap, you know the event risks, and you see the institutional traps. Now you need the hard technical levels.
The strategy desks have drawn definitive lines in the sand for the open. For the S&P 500, the critical structural pivot is 7,400.
That level isn't arbitrary. It perfectly aligns with the 50-day moving average and a massive node of historical volume. It is the institutional floor.
For the Nasdaq 100, the line in the sand is 28,000.
The index closed Friday, teetering at 28,128. It is one headline away from a structural breakdown.
The game plan is binary. If the indices can hold 7,400 on the SPX and 28,000 on the NDX on a daily closing basis, the primary bull market trend survives the gauntlet.
But if those levels break, the current neutral consolidation sentiment flips to defensive capitulation instantly.
The algorithmic sell programs will trigger, and the tech sector will officially enter a severe correction regime.
The margin for error is zero.
But before you finalize your risk models for the week, consider a structural thought regarding that ECI wage data on Friday. We have spent this entire deep dive obsessing over the tug of war between AI infrastructure costs and Fed interest rates.
We are modeling out GPU depreciation and treasury yields. But what if we are entirely misdiagnosing the primary collision?
Look at the human element of the macroeconomy. What if the market finally capitulates and accepts that the timeline for AI monetization is simply years further out than currently priced?
Tech valuations permanently compress. But simultaneously, the ECI data on Friday unexpectedly surges, proving that wage push inflation is deeply structurally embedded in the real economy.
It would trigger a complete regime change on Wall Street.
Imagine a market environment that completely stops rewarding the speculative promise of future technological innovation and aggressively pivots to purely rewarding companies that sell basic consumer necessities today.
A market where pricing power and human labor costs become the only metrics that matter. What does your portfolio look like when the boring, cyclical, labor-intensive sectors suddenly become the only safe haven, and the technological titans are treated like bloated utilities?
It's a paradigm shift that actively punishes duration and rewards immediate cash flow.
That is the ultimate tail risk. As you head into the pre-market session tomorrow morning, keep your leverage incredibly tight. Watch the options flow around 7,400 on the S&P, monitor the 10-year yield tick by tick, and respect the volatility. The macro gauntlet is here. You have the blueprint, navigate the tape.